Silver didn't pass. It broke something that was supposed to stay broken. The market is acting like nothing changed. That's the tell. While analysts argue about margins and futures noise, the actual signal already fired. The silver-gold relationship just exited a multi-decade prison. And when a relationship that warped stays warped that long, it doesn't correct politely. It detonates. We're not here to comfort you. We're here to show you what's already moving while the crowd is still debating whether it's allowed to move. Here's what actually happened. Silver lived in a price cage for years. Not because risk disappeared. Not because currencies got stronger. Silver stayed locked while money supply exploded and debt became furniture. That gap doesn't close gently. It stores force. M2 in the U.S. sat near 15 trillion in early 2020. It printed to roughly 22.4 trillion. That's 42% expansion in 5 years. When you dilute the measuring stick, everything measured reprices. And when that repricing starts, it doesn't climb. It resets. Most people are watching the wrong thing. They stare at spot price like it tells the whole story. Spot is the scoreboard. The spread is what's actually happening. The signal isn't that silver moved up. The signal is how distorted silver became against gold and how violently that distortion is starting to unwind. This year, the silver-gold ratio hit levels that barely exist in 50 years of data, not just low. Broken, like a spring compressed past tolerance, held there too long, then released without warning. When markets release that kind of stored energy, they don't drift higher, they explode. We've watched this in other metals that sat quiet for decades. Copper, lead, they didn't politely climb. They kicked through every ceiling at once. Range, then snap, then a new baseline that looked insane to anyone still anchored to the old numbers. Now here's the trap. When something stays suppressed long enough, the correction doesn't stop at fair. It overcorrects. That's not theory. That's how markets punish everyone who refused to believe. Stocks do it in crashes. Commodities do it in breakouts. The move isn't designed to be comfortable. It's designed to eliminate disbelief. When people say silver can't do that, what they're really saying is their mental model can't update that fast. Let's strip this down to what's actually driving force. Yes, industrial demand matters. Solar, electronics, AI infrastructure. Silver is wired into the physical economy like plumbing. You don't notice it until it's not there, and then everything stops functioning. But the deeper engine is monetary. Silver isn't just a metal you consume. It's a metal people run to when they stop trusting the unit of account. That's why the ratio matters. Silver doesn't need to outperform on headlines. It only needs to normalize against gold. And normalization, when it's been delayed this long, is violent. Historically, a 2% silver-gold ratio isn't unusual. It's normal across many years outside major bull runs. The explosive cycles are different. In those, the ratio didn't stop at normal. It ran to 3%. It ran to 6%. That's not prediction. That's documentation of what happens when the market stops pretending. Right now, we're nowhere near those old peak relationships. So the question isn't whether silver is expensive. The question is whether silver is still early in a forced rebalancing. Here's where people get destroyed. They obsess over daily noise. Did the exchange hike margins? Did a headline spook paper traders? That's foam on the surface. Supply, demand, and confidence are the tide underneath. And we have a structural supply problem, not a shortage today. A mismatch where demand is growing faster than new supply can possibly arrive. Mine supply doesn't update like software. It updates like a decade-long construction project. So if industrial demand keeps accelerating, the market has two options. Bid price high enough to ration demand or pull metal from existing holders. That's the entire mechanism. Here's a thought experiment that cuts through the fog. Silver hit $50 in 1980. People treat that number like a ceiling. It wasn't a ceiling. It was a moment in a different currency. Adjust that $50 into today's purchasing power, and you're not talking about $50 anymore. You're talking about somewhere near $190 to $200. That's not speculation. That's arithmetic. The other $50 moment, 2011. Adjust that forward and you're closer to the $70s, which tells you something brutal. If silver is near that zone now, it's not overheated. It's finally back where a prior cycle already lived. So when someone says silver is already high, the question is high compared to what? A memory or a measuring stick that's been debased? I'm going to be precise here because we manage risk, not fantasies. We don't say definitely. We say if X continues, the upside case strengthens. If the ratio keeps climbing toward prior bull cycle peaks, and if gold holds its breakout structure, then the upside scenario for silver isn't a slow grind. It's a velocity phase, the kind that compresses years into months. That's why the $200 discussion exists. Not because someone loves round numbers, because the inflation-adjusted prior peak sits in that range, and markets often tag those old landmarks fast once the unwind begins. But here's the part that should make you uncomfortable. Markets don't stop at fair value. They overshoot. They do it because positioning is wrong, because liquidity is thin, because everyone waits for confirmation and then stampedes in together. So it's not just can silver reach a large number. It's can silver shock people who believe the old range was permanent. History says yes. Emphatically. If you're thinking silver already missed the move because copper and lead broke out years ago, good. That discomfort is useful because it raises the real question. What happens when the laggard finally moves? Sometimes a market lags because it's building pressure. Sometimes it lags because it's being ignored. Sometimes it lags because the public narrative is completely wrong. But when the laggard wakes up, it often moves with extra violence because it has more distance to close. And we've already seen the first clue. Acceleration. Silver didn't crawl back to a prior ceiling. It sliced through levels that acted like concrete for years. That's not a normal bounce. That's a regime attempting to change. Here's the mistake most people make right here. They think a breakout means up smoothly forever. No, breakouts are violent. They whipsaw. They pull back. They generate fear specifically designed to shake out weak conviction. Volatility isn't the enemy of a breakout. Volatility is the breakout's defense system. It filters out anyone who doesn't actually believe. So if we get sharp dips, the question isn't, is it over? The question is, did the structure break, or did the market just test who's real? Now let's widen the frame, because this is bigger than silver. There's another spread that matters, and it's the one nobody at the equity party wants to acknowledge. Gold versus major stock indices has been coiling for years. For over a decade, gold traded in a broad range against the S&P and big tech. People mocked it, called it dead money. But that range was a foundation. And when a decade-long foundation breaks, it's not a trade. It's a leadership shift. Gold recently pushed through long-term relative resistance versus key equity benchmarks. That means monetary metals are reasserting as an asset class, not just a niche hedge. And it's not only gold. Miners are waking up relative to stocks. Silver is waking up relative to stocks. That signals capital rotation, not retail enthusiasm. Connect the dots. If equities have been the default allocation, and that allocation starts losing relative strength, capital doesn't disappear. It migrates. It searches for a new home. And when that migration hits a market with constrained physical supply, you don't get a gentle repricing. You get a time squeeze. Let's define what we're actually watching, because this is where smart people get lost in noise. The silver-gold ratio is simple. Silver's price divided by gold's price. Why it matters is even simpler. It strips out the dollar's disguise. It tells us which metal is leading inside the same monetary storm. Apply it here, and the message is loud. Silver spent years acting weak. Gold moved. Silver hesitated. The ratio collapsed. That collapse wasn't normal. It was structural stress. When that ratio starts rising out of a deep base, the market is saying I want silver exposure, not just gold protection. And silver, because it's smaller and thinner, responds like a small boat in large waves. More speed, more violence, more emotion. Here's the contradiction that keeps people paralyzed. Silver can look expensive on a price chart and still be cheap on a ratio chart. Both can be true simultaneously. That's why anchoring to the $50 memory is dangerous. It's like refusing to pay more than $19.95 rent while living in a 2026 city. Notice how everyone uses $50 as a ceiling, but almost nobody uses ratio highs as a ceiling. That's convenient, because ratio highs tell a different story. In the strongest bull cycles, silver didn't just tag a round number. It forced its way to a much larger slice of gold. That's the leverage mechanism. Gold is the anchor. Silver is the slingshot. Here's the retention test. If gold holds firm and the ratio keeps climbing, what's the bear case? The bear case isn't silver dips on Tuesday. The bear case is the ratio rolls over and dies, and silver can't hold post-breakout territory. That's what we watch. Now add the monetary layer. Money printing doesn't show up in your bank app with a warning. It shows up in prices later when confidence finally wakes up. And confidence doesn't wake up gradually. It wakes up after an event. Sometimes a banking scare. Sometimes a bond spike. Sometimes just the slow realization that paychecks buy less while debts stay the same. When that realization hits, gold gets the first call. Silver gets the second call. And then silver can sprint because it's trying to catch up to both gold and reality simultaneously. That's why the few days concept matters. Not because we're guessing a date. Because breakouts create urgency by design. They force decisions. Either you respect the signal early or you chase it after it becomes obvious. Watch the psychological warfare. The market loves to offer you a bargain, then scare you out of using it. A sharp dip is the bouncer at the door. It checks your conviction. It asks, do you actually know why you're here? If you don't, you leave. If you do, you stay calm. And calm is an edge. Here's another question to sit with. If the ratio climbs toward old bull cycle zones, will you recognize it as confirmation, or will you call it too late right as the real move begins? Because that's what happens to most people. They demand certainty. Then they punish themselves for missing certainty. One more open loop before we end, because this is where the clock matters. Everyone talks about months and years. But when spreads break after multi-year bases, the first explosive window can be short. The market can move the most while people are still debating whether the move is real. Watch the next few closes like they matter. If silver holds its new ground while the ratio keeps creeping higher, the next move probably won't be polite. It'll be a shove. And if that shove starts, the people who waited for confirmation will have to buy from the people who prepared early. Don't get hypnotized by circus noise. Watch spreads. Watch ratios. Watch rotation. When the market admits silver isn't trapped anymore, it won't give you weeks to think. It'll give you days. Let me ask you something.